You ever notice how Bitcoin feels like it should be pumping, but just isn't? ETFs are live. Wall Street is in. Corporations are buying. Supply is capped. And yet price keeps chopping. So what's actually going on? Let's zoom out, because most people are looking at adoption. But markets don't move on adoption alone. They move on liquidity, leverage, and positioning. And that's where things get interesting. Section 1. The expectation trap. When Bitcoin broke 6 figures, a lot of people assumed we were entering the institutional supercycle. The logic made sense. Spot ETFs launched, including products from firms like BlackRock. Public companies added BTC to Treasury. The narrative shifted from speculative internet coin to digital macro asset. So naturally, people expected price to explode. But here's the mistake. Markets price in expectations before they happen. By the time ETFs launched, billions had already positioned for that outcome. Now, let's talk about something nobody likes to talk about: leverage. When large players buy Bitcoin directly, that's one thing. But when entities raise capital through debt to buy Bitcoin, that changes the dynamic entirely. Take MicroStrategy, for example. They've effectively turned themselves into a leveraged Bitcoin vehicle. They raise money through convertible notes, equity offerings, preferred shares. Then they use that capital to buy BTC. It's a bold strategy, but leverage introduces sensitivity. When Bitcoin rises, leverage amplifies gains. When Bitcoin stalls or drops, pressure builds. And markets are forward-looking. If traders believe leveraged holders might be forced to sell under stress, they position accordingly. You don't need conspiracy theories. You just need incentives. Here's a truth most retail investors ignore. Price is determined at the margin. It doesn't matter how many people believe in Bitcoin long-term. It matters who is buying and selling today. When rates stay elevated, risk appetite tightens, liquidity contracts, speculative assets compress, even strong ones. Bitcoin doesn't live in a vacuum. It trades in the same global liquidity system as equities and tech. There's also something else happening. When Bitcoin stalls near all-time highs, it creates frustration. People who bought at $100,000 expect immediate validation. When they don't get it, conviction weakens. Markets love exploiting impatience. Strong hands accumulate when weak hands question themselves. That's not manipulation. That's market structure. Institutional adoption is real. Scarcity is real. But price doesn't move in straight lines. The more financialized Bitcoin becomes, the more it behaves like a macro asset, not a hype cycle token. Which means liquidity cycles matter. Debt structures matter. Capital costs matter. And most importantly, time matters. So if you're wondering why Bitcoin isn't at $200,000 yet, despite all the bullish headlines, the answer probably isn't a secret suppression scheme. It's leverage, liquidity, positioning, and patience. And if you understand those 4 things, the price action starts to make a lot more sense. Let's dig into the mechanics. Because this isn't really about secret coordination. It's about structure. And structure creates pressure. How the Bitcoin leverage machine actually works. MicroStrategy has turned itself into something unusual. On paper, enterprise software company. In reality, a corporate Bitcoin accumulator using capital markets as fuel. They raise money in 3 primary ways: selling common stock, issuing convertible notes, issuing preferred shares. Then they use that capital to acquire Bitcoin. As of now, they hold hundreds of thousands of BTC, tens of billions in exposure. That strategy works beautifully in an uptrend, but leverage always comes with obligations. Convertible notes carry interest. Preferred shares require dividend payments. And unlike common dividends, preferred payments can't just be paused without consequences. That creates fixed financial pressure. Why the stock premium matters. Here's the critical concept most people miss. MicroStrategy doesn't just depend on Bitcoin's price. It depends on its stock trading at a premium to its Bitcoin holdings. Let's simplify. If the company owns $40 billion worth of Bitcoin and the market values the company at $55 billion, investors are effectively paying extra for access, management strategy, and future accumulation. That premium allows the company to issue new shares, raise cash, buy more Bitcoin, reinforce the cycle. It becomes a flywheel. Stock premium raise, capital buy, BTC market excitement premium persists. But premiums aren't permanent. If market sentiment shifts and the stock trades closer to, or below, the value of its underlying Bitcoin, that flywheel slows down. And when it slows down, F-streets narrow. If Bitcoin stalls, risk appetite fades, or capital markets get stricter, raising equity becomes harder. When equity issuance slows, the company must rely more heavily on existing cash flow and reserves to service obligations. That doesn't automatically mean disaster, but it does increase sensitivity, and markets price sensitivity aggressively. Even the possibility of forced selling can affect positioning. That's not manipulation. That's how forward-looking markets operate. In highly financialized stocks, short sellers often appear, not because they're coordinating some master plan, but because they're exploiting structural imbalances. If a stock trades far above its underlying asset value, some investors will bet on mean reversion. That's normal market behavior. It happened in leveraged ETFs, commodity trusts, SPSC cycles, closed-end funds trading at extreme premiums. When structure stretches too far from fundamentals, traders test it. The real risk is reflexivity. If Bitcoin drops, the stock premium compresses, capital raising slows, market fear increases. Those elements can reinforce each other. That feedback loop is what sophisticated traders watch. Not secret meetings, not smoky rooms. Structure. It's also worth noting, this strategy has worked incredibly well so far. Early capital raises were deployed at lower Bitcoin prices. Unrealized gains remained significant. The company has repeatedly shown access to capital markets. So this isn't a guaranteed collapse scenario. It's a leveraged sensitivity scenario. There's a difference. If you own Bitcoin directly, you don't have corporate debt obligations. You don't have dividend requirements. You don't have quarterly earnings pressure. That's the structural difference between holding BTC and holding a leveraged proxy. Understanding that distinction removes a lot of fear. Bitcoin's price isn't just about adoption, ETFs, scarcity narratives. It's increasingly tied to capital markets plumbing, debt structures, equity premiums, liquidity cycles. As Bitcoin integrates deeper into traditional finance, it inherits traditional finance dynamics. That doesn't make it broken. It makes it maturing. Now let's talk about what happens when leverage meets volatility. Because this is where markets get uncomfortable. When a company holds a massive Bitcoin position and finances it through capital markets, its stock becomes a battleground for competing views. Some investors believe in the long-term Bitcoin thesis. Others believe the capital structure introduces fragility. And when those views collide, you get volatility. When a stock trades at a large premium to the value of its underlying assets, certain hedge funds will test that premium. Not because they hate Bitcoin, not because they're trying to destroy anything, but because their job is to identify pricing inefficiencies. If they believe the stock is overextended relative to its asset base, they may short it. That's normal market behavior. For example, investors like Jim Chanos have built entire careers around identifying situations where leverage and valuation disconnect. And large banks, such as JP Chase, routinely publish research highlighting structural risks in companies with aggressive financing strategies. That isn't illegal. That isn't coordinated warfare. That's how public markets function. Here's something interesting that can happen. If the company's market value drops below the value of the Bitcoin it holds, the stock may trade at a discount to its net asset value. At that point, the market is effectively saying, yes, you own valuable assets, but we're pricing in risk. That risk might include debt obligations, dividend requirements, refinancing uncertainty, volatility exposure. A discount doesn't automatically mean collapse. It means uncertainty, and markets are ruthless with uncertainty. The key concept here is reflexivity. If Bitcoin drops, the company's asset value drops. The stock may fall faster. Capital raising becomes harder. volatility increases. But the reverse is also true. If Bitcoin strengthens, asset value rises, equity premiums expand, capital access improves, short pressure can unwind. These feedback loops work both ways. Markets amplify strength. Markets amplify weakness. That's not a plot. That's leverage interacting with sentiment. This is where many retail investors get confused. A leveraged company holding Bitcoin is not the same as holding Bitcoin directly. Bitcoin itself has no CEO, no dividend obligations, no quarterly earnings calls, no refinancing risk. A corporation does. Understanding that distinction removes a lot of unnecessary fear. If a company mismanages leverage, that reflects on the company, not on the protocol. Now let's talk practically. If you're a long-term Bitcoin holder, volatility driven by capital structure stress can feel personal. It's not. It's structural. Professional investors think in probabilities and time horizons. Retail investors often think in emotions and recent price moves. That difference matters more than any macro theory, because the edge in markets rarely comes from secret knowledge. It comes from emotional discipline. If volatility increases due to leverage stress, most participants will panic, overreact, sell into weakness. But investors who understand structure ask a different question. Has the long-term thesis changed? If the answer is no, then volatility is information, not a threat. As Bitcoin becomes more integrated into traditional finance, it will increasingly reflect credit cycles, liquidity conditions, risk appetite, capital market mechanics. That's maturation, not manipulation. And understanding that shift gives you clarity. Because once you understand the plumbing, the price action stops feeling random. Here's the real difference between retail and professional investors. When price drops, most people ask, should I sell? Professionals ask, what changed? That's it. Not, who's attacking us? Not, who's manipulating the market? Just, did the long-term thesis break? Because price and value are not the same thing. Price moves on positioning, liquidity, leverage, and emotion. Value moves on fundamentals. Those two don't always line up in the short term. Bitcoin dropping 20% doesn't automatically invalidate its fixed supply, its global adoption, its integration into financial infrastructure. It means markets are repricing risk. That's normal. Every emerging asset class goes through this phase as it becomes financialized. Gold went through it. Tech stocks went through it. Even broad equity markets went through it during tightening cycles. Volatility is not proof of failure. It's proof of participation. In the late 1990s, gold was widely dismissed. Central banks reduced reserves. Institutional interest faded. It traded under $300 per ounce. Years later, it became a core macro hedge again. The lesson isn't conspiracy. The lesson is cycles. Assets move in waves of enthusiasm and doubt. Understanding cycles is more powerful than trying to predict headlines. Here are practical takeaways. 1. Separate the asset from the vehicle. Owning Bitcoin directly is not the same as owning a leveraged corporate proxy. 2. Monitor structure, not just price. If leverage increases dramatically or refinancing risk spikes, that's meaningful information. 3. Respect time horizons. Short-term volatility is noise for long-term theses. 4. Manage position size. No asset, no matter how strong you believe in it, should be sized in a way that makes you emotional. Because emotion destroys returns faster than volatility ever could. The biggest edge in markets isn't secret data. It isn't inside access. It's emotional control. When markets get loud, disciplined investors get quiet. When narratives get dramatic, disciplined investors get analytical. When others panic, disciplined investors reassess. That's how capital compounds. As Bitcoin integrates deeper into traditional finance, it will behave more like a macro asset. That means credit conditions will matter. Liquidity cycles will matter. Leverage will matter. That doesn't weaken the thesis. It matures it, and maturity comes with complexity. If you believe in the long-term value proposition of decentralized, scarce digital assets, then short-term turbulence shouldn't dictate your strategy. If you don't believe in that thesis, volatility will always feel unbearable. That's a personal conviction decision, not a market one. Investing isn't about predicting every move. It's about understanding structure, managing risk, staying rational, letting time work in your favor. So instead of asking, "Is this manipulation?" ask, "What does the structure tell me?" If this breakdown helped you think more clearly about what's happening beneath the surface, subscribe for more deep dives into how markets actually work. And remember, know what you own, know why you own it, and never let volatility make decisions for you. I'll see you in the next one.